$5.5 were evaporated from the stock market in the past 2 trading days, one of the worst stock market performance in decades, triggered by worries about Trump's tariff policy, which raises the question, why is Trump imposing these tariffs? To understand this, I will show you a bunch of charts to show the US share of global economy in percentage since post-World War II era, since 1950 until today. And this chart shows you that the US exports of goods was around 25% in 1950, and now 70 years later it's down to 8%. On the other hand, on the service side, we have the data from year 2000 until 2022. The global US service export was around 19% in 2000, and right now it's down to 13%. And the official foreign exchange reserve for US dollars went from 70% in 1999 all the way down to 58% today. The US GDP was 25% of the global total GDP in 1950, and now it's down to 15%. The US stock market cap was at 60% in 1950, and now it's actually higher. It's at 64%. So since we talk about GDP and market cap, then we have to talk about the Buffett Indicator, which uses US market cap divided by US GDP. It's currently at 211%. So US share of the global economy was shrinking in the past 70 years in terms of GDP, but valuation for its stock market is increasing over the past 70 years. There is this divergence. This divergence appears to be unsustainable. That's why this Buffett indicator is so high. It's indicating a possible imbalance and overvaluation. This is why I think Donald Trump is doing what he's doing, is to try to restore US manufacturing capabilities and bring the manufacturing back to US. The goal is to boost domestic goods and services output, not only domestically, but also output them to the world. He is trying to strategically maintain the US global leadership and maintain its economic dominance. Because if he doesn't do this, right, if one day the US dollar is ditched, it's no longer the world reserve currency, what else does America have? Of course, there are a lot of risks that comes with tariff policies that he implemented, especially on April 2nd, right? He was attacking everybody, including Europe, China, and most of the world. So if the US is seen as a country that abandons its allies, its reliability as a partner will be questioned or even challenged. American allies would lose trust in the country and could be reconsidering other relationships, right? So this may lead to a reduction in US dollar reserves. And they can also decide not to use US dollar as much, right? There will be a decline in US dollar denominated trades, which of course would challenge the world reserve currency status. And so far what we have seen is that China's response to Trump's tariff are very quick, very harsh, and there's no sign of concession. So if this tariff war escalates into a trade war between US and China, who is better prepared? To understand this, we must examine the trade dependencies, especially the US imports from China and Chinese imports from US. Now this chart highlights the top US import categories from China, and in each category, blue color represents China's exports to countries other than the US in dollar value. Black represents US exports from China for that category. Gray represents US imports from other countries for that category. The chart shows us that a large share of imports are smartphones, computers, and other consumer stuff and consumer electronics, which means when US put tariff on Chinese imports, these consumer-oriented goods will be directly impacted. Consumers will see higher price tag when they go to places like Walmart, right? So this will directly push the CPI or consumer price index higher, driving inflation higher immediately for the consumers. And US CPI inflation gauge is showing us that the overall CPI year over year is at 2.8%. Core CPI year over year is at 3.1%, indicating that America is still fighting the inflation war because the long-term inflation goal is at 2%. Now, the US Fed funds rate, or the policy rate determined by Federal Reserve, is currently at 4.5%. In comparison, China's one-year prime loan rate is at 3.1%. This is reflecting that US is having an ongoing inflation war, and its monetary policy is tight. In contrast, China has a looser monetary policy and have less inflation pressure. This chart highlights top US import category from China, and for each category, blue represents China's export to other countries other than US, black represents US imports from China, gray represents US imports from other countries other than China. The chart shows a large share of imports being smartphones, computers, and other consumer electronics and consumer goods. So finished consumer goods are imported from China into US. When US applied tariff on these goods, it would directly impact the consumer price index. The price tag at Walmart, the price tags at Amazon would be going higher right away, driving inflation higher for the consumers directly. And the US CPI inflation remain elevated today at 2.8% from year over year. And the core CPI inflation from last year, it's up 3.1%, meaning that the inflation fight is still ongoing in America. And the US Fed funds rate currently is at 4.5%. In comparison, China's one-year loan prime rate is 3.1%. This reflects that the U.S. ongoing inflation challenge and Federal Reserve is implementing a tighter monetary policy. In contrast, China has a looser monetary policy and having less inflation pressure. This chart displays top category of Chinese import from U.S. For each category, blue representing U.S. exports to countries other than China. For each category, black represents China's import from US for that category. Gray represents China's import from other countries. So as we can see, the most imports from US are agricultural product like soybeans. And there is intermediate goods like LNG, crude oil, right? So a lot of raw material are being imported from US into China. And if China raise its tariff on the US import, that would mainly impact Chinese producer price, not the consumer price. Affected imports are upstream goods like raw materials. So China's current producer price index, or PPI, the producer inflation gauge, is actually down 2.2% from the same time last year, indicating a deflationary pressure being seen by the Chinese producers. And while producer inflation can eventually pass down to the consumers, China's current consumer price index is also low. China's CPI is down 0.7% year over year, signaling a deflation. And this contrasts with US, which is battling with inflation. So on paper, if we look at the inflation aspect, China appears to be better positioned than the US to handle trade war due to the low inflation and looser monetary policy. However, I don't think you can look at this only from the inflationary aspect. China is already facing deflation. So with a sluggish economy that needs stimulus from the central bank, so cutting off trade with US would worsen this for China. In 2024, China's total export was approximately $3.37 trillion, with exports to United States accounts to $501 billion. That's 15% of its total global export. So during the same period, China imported goods is worth $165 billion from the in the USA. Now let's assume China and US have a all-out trade war. They don't trade with each other at all. China would lose 15% of its total global export, which would deepen its deflation and further slow its growth. And that would pose a serious risk to China's economy. Thank you. Please like and subscribe.